With the first negative headline economic growth print since the first quarter of 2022, investors are fearing the worst. I'm Michael Drozd, CIO at LaSalle Street. Stay tuned to learn why markets may continue to look through this weakness and why focusing on hard economic data and global trade may prove to be crucial for the remainder of 2025. This growth contraction was largely influenced by corporates front-running the Liberation Day tariffs and financial conditions tightening in the fourth quarter of 2024, feeding through the broader economy. The front-running of these tariffs led to U.S. imports significantly outpacing exports, which had an estimated negative 3% on GDP. Additionally, reductions in government spending, CapEx due to the uncertainty, and consumption, all due to tariffs, contributed to this negative GDP print. However, it's not all doom and gloom. U.S. consumption remains robust, growing at an above-trend pace of 3%. And as so long as the labor markets remain strong, a widespread decline in economic activity is not the most probable outcome in the near term. The Trump administration and the FOMC must continue to balance economic growth while lowering yields and simultaneously creating demand for U.S. government debt. While it is possible we see 2 consecutive quarters of low to negative GDP growth as the administration shifts the economy's reliance from excessive government spending to productive capacity in the private sector, markets appear to be looking through the weak data as a temporary shock from the uncertainty around the implementation of tariffs. If tariffs are no longer being used as a significant budget offset to expand the Tax Cuts and Jobs Act, and with Elon Musk's departure from the Doge team, it raises questions about the administration's strategy on reducing the U.S. budget deficit. If the initial goal was to redirect capital from the overextended public sector to foster a thriving private sector and real economy, it appears the march higher in bond yields, the drawdown in the U.S. dollar during a period of equity market weakness caused the administration to reconsider their goals. Specifically, cyclical U.S. capital outflows, especially from the U.S. dollar and treasury markets, have caused enough discomfort to impact a shift to another outcome: fiscal largesse, higher yields, supporting economic growth, and improving U.S. financial markets. Financial conditions have improved significantly due to a lower U.S. dollar, a reduction in commodity prices, and positive developments on the tariff front, driving a rally in risk assets. Historically, substantial declines in the U.S. dollar, similar to what we have witnessed over the past few months, have led to significant positive environments for equity markets. And if we look ahead, similar signals in the past have resulted in strong equity market performance the following 12 months. And although there are several uncertainties regarding the implementation of tariffs, the current environment suggests a cautiously optimistic outlook. Rollback of Liberation Day sized tariffs is expected to stabilize asset markets, providing some reassurance to investors. Thank you for tuning in, and for more information, be sure to reference our most recent From the Office of the CIO publication. And be sure to tune in to our next episode from A View from the Street. Thanks again.